what is the origin of drill, baby, drill, attributing it to McCain. But I don't know, a quick Google search actually says that Michael Steele was the originator. And I certainly associate it with Sarah Palin.
What we've seen in the last week is that there has been some, not a lot, but some pressure on oil prices. And this is in line with our expectations of a potential Trump win, as we wrote in our preview for the elections.
It is positive, but perhaps not in the way that folks may anticipate at a high level. We put a note out earlier this week suggesting that while Trump's favorable stance towards oil and gas is probably positive for the industry from a profit standpoint, that it may not necessarily translate into increased drilling activity or better performance in stocks.
So just taking a look at the reaction last Wednesday of how the biofuel chain shifted. So U.S. ag, whether it be soybean oil, jumped post-news. Biofuels names, the ones that are heavily exposed, like Darling Ingredients or Neste, for instance, fell. U.S. refiners jumped. And I think that's a reasonable reaction to it.
Some of the downside catalysts for oil prices could be that, I think the big one is tariffs. Those would very likely, of course, mean lower global trade, a lower oil demand, and lower oil prices. Another one that we were talking about was stronger dollar. Of course, this is part of the Trump trade, as the market is calling it now. The expectations of interest rates staying a little bit higher for a little bit longer, because inflation, due to some of Trump's suggested policies, would be higher for longer, and higher interest rates by the Fed could mean stronger dollar for longer. And the relationship between the dollar and oil is not a stable one, but generally, I think that the way the market is seeing this is that stronger dollar could mean just more pressure on oil prices. Another one, I think the pro-fossil fuel stance by the Trump administration could mean higher U.S. Domestic oil production.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, just going to quickly run around. We've got Salih Yilmaz joining from his usual perch in Dubai, swinging across the Atlantic Ocean. We've got Scott Levine joining from an undisclosed location in New Jersey. And we've got Brett Gibbs joining from the Washington, D.C. metro area. So that's the crew for today. We are probably going to spend a fair amount of time unpacking the election and read across from energy markets. If you missed it last week, the morning following the election, we also had a similar discussion with just a slightly different focus. So last week we had Nathan Dean on from our policy team, but we also had Mike McGlone, Vince Piazza, and a couple others. So go back and check out that one if you want to go deep on things like LNG and sort of just a general view of the political landscape. I will flag a couple of things. One is, if you are based in Madrid, and we know some of you are, we're going to be there next week, next Thursday, for an in-person event. That's the 21st. And then the 22nd, we also have an in-person event in London. So make sure to stop by, say hello. We're trying to get out in the field as much as possible where you are and say hello. We will have events coming up next year in New York, Miami, and elsewhere. So stay tuned for all of that. Okay, so let's just do the quick 30,000 foot view. I'm looking at my screen right now. Looks like Brent crude's in the low 70s here at the moment. And Salih, would have loved to get your perspective last week, but we're going to give you the opportunity today. So What's your read? I know we've done some survey work, and you've certainly been talking to lots of folks in the Middle East region about where oil could be headed. So, give us your read of the tea leaves. How does the change in administration affect the outlook for crude generally from your perspective?
Sure. Thanks, Rob. I mean, what we've seen in the last week is that there has been some, not a lot, but some pressure on oil prices, and this is in line with our expectations of a potential Trump win, as we wrote in our preview for the elections. And the way, so our take on it has been that this Trump's second term could be a net negative for oil prices. I mean, obviously there are a lot of moving parts, but the way we've broken that down is that some of the downside catalysts for oil prices could be that, I mean, I think the big one is tariffs. Those would very likely, of course, mean lower global trade, a lower oil demand, and lower oil prices. Another one that we were talking about was stronger dollar. Of course, this is part of the Trump trade, as the market is calling it now. The expectations of interest rates staying a little bit higher for a little bit longer, because inflation, due to some of Trump's suggested policies, would be higher for longer, and higher interest rates by the Fed could mean stronger dollar for longer. And I mean, the relationship between the dollar and oil is not a stable one, but generally, I think that the way the market is seeing this is that stronger dollar could mean just more pressure on oil prices. Another one, I think the pro-fossil fuel stance by the Trump administration could mean higher U.S. Domestic oil production. But I mean, I would argue that when it comes to the production level in the U.S., when you look at it historically, the administration doesn't seem to really matter that much. I think where oil prices are and where the oil companies' strategies are a lot more important than the administration. So I don't really expect there to be a major impact because of a Trump administration on the level of U.S. oil production. But again, I mean, if there was going to be any, it would be a lot more positive with Trump than the alternative. And then those are the downside catalysts. And again, I would rank them in that order. I think tariffs are going to be a lot more important, and then the dollar, and then the level of US production. One upside catalyst that I do want to mention is we do expect either more sanctions or simply stricter sanction enforcement on Iran. And I mean, look at historically how much oil exports could be lost from Iran. I mean, we expect it to be potentially up to 1 million barrels per day in the 3 to 6 month period after Trump comes into office. Again, I mean, we don't know for sure, but I think it's safe to assume that there would be stricter enforcement of sanctions. But so I mean, obviously 1 million barrels per day, about 1% of global supply. This is a significant amount, but I don't think this would be moving prices that much, mainly because of this very significant amount of spare capacity that OPEC Plus currently has. I would suspect that simultaneously the administration would be talking to OPEC Plus to make up for any of those lost barrels. And OPEC Plus could comfortably meet any of those lost barrels. So I don't think there will be any major impact on the supply picture, even with stricter sanctions on Iran. So all of that combined, we just simply see more downside catalysts than upside catalysts on that, and that's why we expect the result to be a net negative for oil prices.
Fascinating. And for anyone listening, feel free to drop questions into the chat. We'll try to get to some of these, or you can IB me. I'm happy to try to work in any thoughts that you might have on your mind. And just on the idea of Iran, I'll flag that we should circle back around on that and get a specific call together on that topic. It is such a big uncertainty. Okay, Scott, let's swing over to you. when you think about your energy service names and kind of how the election could feed into them, I want to get your read. How do you break this down? Is this a potential positive move for some of the service companies or agnostic? How do you read it?
Yeah, I think it is positive, but perhaps not in the way that folks may anticipate at a high level. We put a note out earlier this week suggesting that while Trump's favorable stance towards oil and gas is probably positive for the industry from a profit standpoint, that it may not necessarily translate into increased drilling activity or better performance in stocks. And the mantra of drill baby drill is closely associated with Trump. I don't think, I think the environment has changed dramatically since his last term. And, during his last term, we saw an inflection in drilling activity in first half 2017, 2018, but that was really more the hangover effect of the 2015-16 oil recession. Which was triggered by the war between, well, not war, but OPEC, changing stance and going for market share versus shale. And so we did see a large inflection in drilling activity during that time frame, but I would suggest that was more market forces than policy driven. I do think in general, it's drilling activity is more a function of market dynamics than policy. However, a favorable stance, lower taxes and lesser environmental restrictions could result in lower costs. And thus higher profits for oil and gas companies, which they could invest in more projects to increase drilling and production on the margin. But we don't think that necessarily will have a close correlation with activity levels. And so to Salih's point earlier as well, I think his foreign policy stances toward not just Iran, but also towards the Ukraine and Russia could increase volatility in general. And I think that that could just make for greater uncertainty and more twists and turns associated with exogenous factors that could impact investment globally in oil and gas markets in general. And so the last thing I wanted to highlight here, and we definitely have seen, not just for the oil field service companies, but for oil and gas companies in general, is an increased focus on discipline, capital returns, and less of a pursuit of growth. But from my group's stock performance perspective, that has not translated into improved stock performance in any way, shape, or form. And that includes really every year except for 22, where everything within energy worked. 23 was another poor year for the stocks. This year, same thing, despite the fact that the oil field service companies have committed to return at least 50% of their free cash flow to shareholders. Most of them have reinstituted dividends and have increased their commitments to buybacks as well. And so that suggests to us that these are still very much growth stocks. And without growth as measured by rig count trends or capex increases, by and large, that does not seem to be translating into better stock performance for these companies, at least yet. So perhaps I'll leave it there and turn it back to you, Rob.
Thank you, Scott. Everyone, make sure to check out Scott's note from, I believe it was Monday. It's called Trump 2.0 may lift oil service profit more than drilling. Very interesting note there. From the chat, by the way, thank you. Someone pointed out, what is the origin of drill baby drill? Attributing it to McCain, but I don't know, a quick Google search actually says that Michael Steele was the originator, and I certainly associate it with Sarah Palin. But okay, Brett, let's get you into the conversation. You've got a note out called Trump Biofuel Shifts, Don't Derail Path, Favor U.S. Ag 2025 RINs. So Let's get your thinking here. How could biofuels potentially be affected under the incoming Trump administration?
Yeah, thanks, Rob. So just taking a look at the reaction last Wednesday of how the biofuel chain shifted. So U.S. ag, whether it be soybean oil, jumped post news. Biofuels names, the ones that are heavily exposed, like Darling Ingredients or Nestle, for instance, fell. U.S. refiners jumped. And I think that's a reasonable reaction to it. And how we're looking at it is more in a multi-stage of over the term, the 4-year term of what the impacts are relative to really what's unfolding in the next 2 months and how that's creating a little bit more of a window of opportunity. So starting with more of like the high level views of this, the Trump administration could take a more measured approach to mandates. We've seen that being discussed, and that generally is restrictive on the growth potential for biofuels. But that's also countered with relaxed emission requirements, which preserves road fuel demand after these emission requirements were set to take into effect 2027. Then thinking about the EPA appointment of Lee Zeldin specifically, after hearing that, a lot of conversation circulated that he co-sponsored bills that were to, essentially reduce the impact of the renewable fuel standard, which is a negative measure thinking about the next mandate coming due in 2026. But when you look at that and unpack where we were in 2017, 2018, when he co-sponsored the bills, even 2020 versus where we are now, U.S. Renewable diesel capacity was about, call it 500 million gallons a year. Now we're close to 5 billion gallons a year. And a majority of the growth, over 70%, is centered on integrated oils and refiners. And so we think that adds some durability to mandates in terms of come time to set the 2026 mandate. You wouldn't necessarily actively reduce mandates to destroy margins for the companies that have sunk capital into renewable fuels. That adds some sort of durability. Within that, structurally, the incentives skew a little bit more towards U.S. ag and continuing to have programs that allow U.S. corn, U.S. soybean oil to participate, remain competitive. Other programs have, skewed a little bit more towards carbon intensity-based incentives, which gradually reduce the effectiveness of U.S. corn and soybean oil. So thinking about it on a big picture view, that's how we're thinking about it over the next couple of years, structurally rather neutral. Into 2025 specifically, one of the pending questions is the new tax credit guidance for 45Z that is scheduled to go into effect Jan 1, and we still haven't received guidance from the Treasury. Change in administration, essentially extends inaction here. And we think running through all the different scenarios, absent a extension of the existing policy that's set to expire at year end, they're broadly supportive for RINs and renewable diesel margins into next year because it becomes tougher for us to meet the mandate without any tax credits or with the proposed changes to the tax credits. So it's kind of setting that up, and the 2025 supportive, longer term, slightly neutral.
Thank you, Brett. Okay, so let's swing back over to you, Salih. I want to get some big picture questions in front of you. One of the questions kind of relates to China, not super election focused, but is there evidence of a change in oil demand in China as a result of increased EV and hybrid cars? But I also want to pose that question not just for China. How are most people, if you haven't seen on this call, there's a pretty fast rise in EV sales globally, still relatively small share of the total fleet out on the road, but it's an increasing share, certainly, of new vehicles being sold. not just in China, US, Europe, on down the line. So, Salih, give us your read on, kind of what's going on with that component of the energy transition, and do you see any big differences there under Trump as well?
I would say yes. I mean, you're right. Like in the grand scheme of things, you could argue that a big majority of the fleet in China or the rest of the world are still internal combustion engine, even though a lot of the new car sales may be EVs, especially in China, because China is actually manufacturing a lot of EVs themselves and selling them domestically. I think the argument has been that this may not really move the needle just yet because we just don't have enough of them just yet. And explicitly, we're not really seeing many talk about it. But then look at the OPEC demand numbers for the last 4 months, and the last report came this morning. And for the fourth month in a row, they lowered their demand forecast for next year. And again, arguably, this is not necessarily mainly driven by EVs or hybrids. Arguably, it's more the real estate sector that's really been struggling in China. But increasingly, I think it is really EVs, eating away from the road transport part of oil demand. And anecdotally, we did a marketing trip in China last year in September, and it was actually quite fascinating to see, especially in Shanghai, that almost all cars you saw were EVs, and it was quite fascinating because it was very different in the sense that you wouldn't really hear any car noises because you're so used to it, and then when that's not the case, it just felt very different and strange in a way. So yeah, I think there are probably bigger drivers of these demand revisions by OPEC, and I mean we've seen some down revisions by the IEA as well in the last year or so. I mean, arguably that's being driven more by the real estate sector than EVs for now. But I mean, the trend is clear, and I think the writing is on the wall that this will be a bigger driver of the drop in, not necessarily a drop in the absolute number of oil demand, but a drop in the growth level that we've gotten so used to seeing in China. It may just be a paradigm shift, which is what the IEA was calling it earlier in the year, that maybe we shouldn't expect the average demand growth number that we gotten so used to between 2010 and 2020. Maybe that number is just going to be half of what we're used to in the next 10 years. And I know that was the first part of the question, and I think there was a second part, but I can't quite remember it now.
All good. I mean, I think just kind of getting some clarity on, kind of what's going on with the demand story, how EVs are impacting it. I'm curious, just is there still the mismatch that we've seen between IEA and OPEC? And how do you think this kind of question feeds into how OPEC will respond and kind of make adjustments at their next meeting?
Yeah, I mean, it's gotten a little bit closer, but there is still a bit of a divergence. I mean, we've talked about this a few times on this call on how essentially the IEA was expecting oil demand growth this year to be about 1 million barrels per day, and OPEC was expecting it to be more than double that number. And IEA has revised it down just a little bit, and OPEC has been revising it down, as I said, for the fourth time in a row now, but there is still a bit of a difference. And, I think they'll just keep revising. But as things are looking, it's more likely that OPEC keeps revising down than IEA has to revise up these numbers. And, I mean, this is kind of like a moving number. Even into 2025, we will see them revise their historical numbers. So, but my guess, given the trend that we saw in the last few months, it's probably going to be OPEC's number moving closer to the IEA. And we've already seen this impact OPEC's decision already in the last two decisions that they took. And as you may be familiar with already, and I think we talked about this on the call, they had to delay their planned output hike not once, but twice now. So now the guidance is that they will keep the current level of output cuts all the way to the end of the year. But as things are looking, because the market fundamentals are still looking soft, not only for the fourth quarter, but at least for the first half of next year, I just don't see how, unless suddenly we get some demand indicators that are surprisingly very good, or we get some indicators that supply from outside of OPEC Plus is not growing as much as expected. I think OPEC is in a very difficult position, and I think they may just be pushed to kick the can down the road for a little bit longer, buy themselves a little bit more time, because as things are looking, the physical market is not as tight as we thought it would be. So I think if they still want to keep supporting prices, they may just have to delay the planned output hike for at least a couple more months. Would be my take.
Very interesting. For anyone who doesn't know it, I would encourage you take a look at Salih's dashboard. So you can visit BIOPEC. You can take a look at what's going on with data related to demand. I just pulled up Norway. I'm always curious about that one because they're approaching nearly 100% penetration of electric vehicles for new car sales. They're essentially there, and demand looks like it's been trending down there, but it certainly hasn't fallen off a cliff like maybe some folks would have expected. But it's sort of like a sort of undulating plateau, perhaps a slow march downward, but certainly not a complete reversal. I see there's a couple questions in the chat just related to the COP meeting, the Paris climate conference, as sometimes it's referred to in the past. But I think that apparently the Exxon CEO, Darren Woods, has said that the U.S. shouldn't abandon the Paris Climate Accords. I've seen some headlines insinuating as much. And, I think these are sort of big picture questions that don't really feed into the market narrative too much in my view. But Scott, I'm curious on kind of how you think about this question a little bit, because I think a number of the companies that you cover would have in the past been considered oil service companies. Now they've really branded themselves as energy service companies, I believe. I think, are they sticking to that narrative? Are they really energy service companies? How much is the wind, solar, the transition kind of stuff really feeding into what they're up to? I'm curious to get your sense of how important that piece of the business is now, and potentially where it could be headed under a second Trump term.
Yeah. So certainly that rebranding is still, and that emphasis is still there. I wouldn't say that the second derivative is still moving in that direction, and that things have stabilized. But certainly, the emphasis on services to support the energy transition is still there. It's still there for the large cap oil field service companies, or energy service companies as we call them, like Schlumberger, Halliburton, Baker Hughes. Pretty much across our coverage universe, whether it's environmental, infrastructure, or energy services traditionally, all of these companies have an iron in the fire, at least one or two businesses that are tied to the energy transition. So I do think that commitment is still there. I think what's also happened at the same time is that they've really tried to emphasize the fact that this is going to take a long time, and promote a much more sober view and realistic view in terms of the timing at which the energy transition proceeds, and that includes some of the areas that one might consider to be further out in terms of timing of impact, and one of those is hydrogen. And so we listened actually to Plug Power's earnings call yesterday. They're hosting their symposium today, and that's a stock that once upon a time traded at $70, in early 2021, and is now at $2. And the emphasis on green hydrogen, really decarbonizing some of the harder to abate sectors in the economy, that folks in general, the market in general, has gotten certainly less confident in their growth prospects as a bellwether play on this theme. But if you listen to all the earnings calls from oil and gas companies, service companies as well, and others that might support the infrastructure build out for hydrogen, they're still proceeding and progressing with those initiatives. And so while the market may be much more skeptical regarding their near-term potential and their potential in a Trump administration, I might add, the stock was down maybe 20% the day after the election, or at the very least down double digits, along with a lot of the more speculative energy transition or renewable clean tech stocks. It has regained and is up today, despite the fact that they're guiding well below the street. And folks are very interested, just to finish the square the circle on that. But they are pursuing a loan guarantee, federal loan guarantee, to support the build out of one of their facilities in Texas. And they're still expecting or hoping to get that before Trump takes office. So the punchline really is that, yes, these companies are still promoting themselves as energy transition plays, albeit with a much, I guess, more realistic sense in terms of the timing and magnitude versus what the market may have expected, say, 5 years ago.
Very reasonable. Brett, let's bring you into the conversation as well. Just looking at, make sure I got my timeline here correct, but a couple of years ago, 2022, Chevron acquired Renewable Energy Group. So you really have seen in the U.S., I think, this move to the idea that biofuels are at least some component of the energy transition, and you've got at least at this, that's a sort of confirming signal of that idea. But I'm curious to get your sense. Does the example of Chevron acquiring Renewable Energy Group, or just the fact that many of the big U.S. refiners on down the line have exposure to biofuels, does that sort of create a natural constituency that's quietly lobbying and pushing for biofuels in the marketplace, even under sort of a Trump administration? Or what's your sort of calculation on the risk that some of these policies, get walked back because they're not sort of traditional energy? Do you think they're safe? And how does the fact that we've seen real investments in this business feed into kind of how you think it might play out in those DC conversations?
Absolutely. I think that's the biggest argument for why mandates would be anchored and supported, because previously a lot of these refiners or big oil companies were the big opponents of the renewable fuel standard. And now pretty much every one of the 7 independent refiners that we cover has a good level of biofuels exposure. Chevron, you mentioned, with Renewable Energy Group. Exxon, a little bit more measured, but they're planning to have a plant ramped up actually in Canada through their Imperial joint venture next year. So a lot of the opposition previously to this, I think, would rather preserve margins where they are, given the amount of capital sunk in biofuels. And
Yeah, I
Brett,
can't hear Brett.
I lost you at least. Salih, did you?
Yeah.
Scott, have you guys lost Brett as well? Brett, you
Yeah.
still there? Okay, I think we'll try to swing back around to you, let you finish your thought if you're still here. We're a couple minutes past, but we'll go ahead and run over just a tad. I would like to quickly get some readout from the 3Q earnings dialogue and kind of hear how you guys think these companies are positioned for the remainder of 2024 and into 2025. So Salih, you cover one of the world's largest companies. Let's hear your thoughts on Aramco and the sort of broader set of your coverage. How's 4Q looking? What's 2025 look like?
Sure. I'll try to keep this brief. The Aramco numbers were pretty much in line with what we were expecting, kind of like normalizing profitability. We know oil prices were a little bit lower, refining margins were significantly lower, but this was in line with our expectations. I think with that in mind, we expect that trend to continue into 4Q and potentially the first quarter of next year. And that's across the peer group. But on Aramco, I think the interesting bit there is that they have been paying special dividends on top of their base dividends. And the formula for calculating this performance-linked special dividend was looking at profitability from the very profitable 2022 year. And this is why they have been paying a dividend of about $31 billion every quarter. The issue has been, it's not much of an issue, but what's important to note is that their free cash flow generation in the last few quarters have been around $20 billion. So there was that shortfall of about $11 billion, which meant that this massive net cash position that they had has been trimmed down. And as we anticipated in the third quarter, this actually flipped back into a net debt position. It's still a very small net debt position. I mean, the balance sheet of the company is still very strong. Their gearing is still much lower than the global peers. But now I think the interesting point is that they do find themselves in a bit of a dilemma where it's very important that they give these dividends. One, to have a dividend yield that's competitive with global peers, but also two, a big chunk of these dividends are going to the Saudi government, which has a very ambitious economic transformation project at home and needs the funds to go ahead with those projects. But at the same time, for Aramco, now they're watching their gearing go up. So they'll need to decide what level of gearing they are comfortable with so that they can keep paying dividends that are perhaps higher than the cash that they're generating. But obviously, this is not sustainable in the long term, and they cannot do this forever. So it's just a matter of where they take their net debt and gearing level so that they can give these dividends to the minority shareholders, but especially the Saudi government to fund these ambitious projects.
Okay, very interesting, Scott. Similar question for you. Let's get the readout from 3Q. How's the rest of 2024 look, and what are you anticipating for 2025?
Yeah. So firstly, I'd say the earnings season, the big incremental data point, I think, as it relates to both 4Q and 25, is that the international spending story is slowing. Everybody knew that North America was weak to begin with, but clearly growth expectations outside of North America are slowing. That includes the Middle East, that includes Latin America, that includes pretty much everywhere. And so Schlumberger, probably gave the most definitive guidance for next year, and they're expecting low to mid single digit growth in upstream capex outside of North America. And they're expecting, call it low to mid single digit decline in North America, which is somewhat comparable or maybe even a little better than what we'll see for this year. And so I think the reality is that the international upstream spending cycle is slowing for certain. The other incremental data point that I would throw out there specifically relates to offshore, which has probably been one of the areas where there had been the most optimism, and which is a significant component of that international growth story. and the expectation there has also dimmed. And they're the last companies to report. They reported for the most part last week. We also had Seadrill today, and I think this is much more of a long cycle story than shale, and there's still a commitment to these long cycle projects, even with the lower commodity price deck that we're seeing out there, with the weakness in oil prices. As long as there's conviction that longer term prices hold 60 or above, a lot of these projects, or most of these projects in most basins, will be economically viable. And so that is still the case. And so, but what's interesting really is that the interim look through, say, middle of next year at the very least, has certainly dimmed, and we've seen a lot more white space on offshore drillers' calendars. There's a lot more concern that the slowdown in contracting that we saw in the first half of this year and even late last year will continue into the first half of next year, and that is now our expectation. And the stock performance, maybe lastly, of the offshore drillers, which is probably the weakest of the oil field services subsectors, suggests that market participants expect that to be the case too. And so certainly moderating growth and stronger outside of the U.S. than in the U.S., but certainly weaker than had been expected last earnings season.
Okay, fantastic, Scott. Okay, Brett, let's swing back around. I think you've got your IT issues sorted. I think you were kind of mid-sentence on talking about a little bit of the policy risk given sort of refining and downstream exposure to biofuels. Feel free to go ahead and sort of revisit any thoughts you had there. But I was also hoping to get your read on just kind of, we've heard 3Q. What's your anticipation for 4Q and into 2025 for the names you cover as well?
Yeah, absolutely. And apologies on the disruption. So I'll finish my thought there. But I think that's one of the biggest components just in terms of the amount of capital and relative capacity of the oil majors and refiners that add staying power to the renewable fuel standard. Yes, you might not see mandates grow exponentially the 4 years under Trump's second term, but at the same time, it adds resilience given the fact that the oil majors and refiners who are the obligated parties under these schemes themselves have the capacity that don't want to see margins tank and the economics of these projects go away, given that they want to use their existing infrastructure in the energy transition scenario and promote biofuels. So I'll leave it there on that. From the perspective of thinking about 3Q for our coverage and into 4Q, I'll break it down across renewable diesel centered folks. So Darling and Nestle, our view is that margins were going to continue to regain or be on the mend after the trough that we saw in 2Q. Measured expansion in 3Q, but really was another weak quarter. 4Q, we continue to see margins based off of benchmarks rising, kind of following the 2025 narrative that we think margins are supportive into next year. I'll just call out Nestle specifically, as a majority of their capacity is foreign based in the new program schemes, absent an extension of the existing tax credit. They're at a disadvantage. So that's something to keep in mind with Nestle. And then they've also had a series of operational disruptions. And this past week, there was another one at the Rotterdam facility, and this really hinders their ability within the next 2 months under the existing tax regulations to capitalize on margin opportunities. So that's a setback for someone like Nestle. From an ethanol side, 3Q is seasonally strong from margins. So looking at a name like Green Plains, benchmarks have really fallen off in late September, early October. So it's setting up to be a challenge 4Q for them. A company like Green Plains is heavily tied to certain tax credits within the IRA and also the timing of carbon capture equipment to start to monetize that. So that's looking at Green Plains. And then just from a refiner side, it's really a flight to quality refiners with large balance sheets, typically your big three, even more so Marathon and Valero, who have strong balance sheets, can run at really low refining margins, have the highest EBITDA per barrel of the group setting up into next year. But at the same time, from a margin perspective, there is some sort of resistance, which lends some support into 2025.
All right. Thank you so much, Brett. Thank you for everyone who's tuned in today. We hold these calls every Wednesday at 10 a.m. New York, 3 p.m. London. We'd love to see you in person next week in either Madrid or London. If you're based in either of those cities or nearby, please do come see us in person, say hello. We don't want to just be a face on the screen. And again, thank you for your time today. Reach out to any one of us on the call if you have follow-up questions or you want to talk more deeply about our research or any of our coverage. Okay, look forward to being in touch. Take care, everyone. Cheers.